Hi, I'm Merryn Somerset Webb, Editor-in-Chief of MoneyWeek magazine. Thank you very much for joining us at this webinar today. I have with me Charles Plowden. Hello, Charles. Thank you very much for joining us. Now, if anyone has had a front row seat at the great equity bull market of the last decade or so, it is Charles Plowden, who is senior partner at Baillie Gifford and soon to retire. Now, Charles has spent basically his entire career, right, Charles, at Baillie Gifford. You joined in 1983, you retire in a few months, and you end your career as co-manager of the firm's 3.6 billion Baillie Gifford Global Alpha Growth Fund, and also the lead manager of the Monks Investment Trust, which I know an awful lot of our readers hold, and you've been managing that since 2015 and have a fairly stunning record, which of course we want to talk about today. Monks has returned 220% over the last 5 years, which is very significantly more than the relevant index. Though, of course, I know that Baillie Gifford do not really believe in following index. Still, it's interesting for the rest of us to see how that works. So we're going to talk about all these things today, about your career, about how you invest, about Monks, and about Baillie Gifford as well, and its style of investing, etc., and what has made the firm such a phenomenal success over the last 20 years or so. Right, onwards. So can we start, Charles, if you don't mind, with a bit of big picture about your career and how it's gone? What drew you to investing back in 1983? It was really some time ago now. What drew you to that? What drew you to Baillie Gifford? And what have been there's a big question, obviously. What have been the big changes that you've seen in the investment industry over that long and interesting career?
Okay, well, if I start with my own journey, I knew that I wanted to do something in finance, something in investment. I'm the younger son of a farmer, so I didn't have many options in the family business, so I had to go and find my own thing to do. And through talking just to two or three people, I learned that if you want to work in the markets as an investment banker or as anything, the best training you could do was company analysis. So I said, well, where's the best place to learn how markets work and how companies work? And so I was pointed towards investment management. And where was the best place to train in investment management? It was in Edinburgh, where at the time there were half a dozen firms that really were very different from the London firms. I think much more fundamental. We actually read the annual reports rather than sort of just looked at the pictures. So when I came to Edinburgh, it was with a view to doing 2 or 3 years, it was the equivalent of going to law school. I was going to get a qualification in investment management, and then I was going to go to London and do something else, but in the city. And I joined Baillie Gifford, which at the time was a very small, almost anonymous firm. And almost from the moment I joined it started doing rather well. So there was always another opportunity. So having intended to stay for 2 or 3 years, I've stayed for 38. And there's always been another excitement to look forward to, another opportunity, another challenge. So it's just that I've never needed to fill in a CV.
And never been tempted to head bright lights of London?
I was tempted early on, but that was more for social reasons than professional reasons, I suspect. And then, of course, once you become a partner in a firm like Baillie Gifford, why would you ever leave? Because, even as a junior partner, you're obviously not your own boss, but you do have, you think and behave like an owner. And you have, so it's an offer that most other managers, even then, couldn't offer. The chance to have, from day one, a big shareholding in the company you worked for, and to have a say in the long-term direction and sort of those sort of responsibilities. So once you get locked in as a partner at Baillie Gifford, it is quite difficult. I mean, it's very difficult for anyone else to tempt you away.
Okay, interesting. And Baillie Gifford was pretty small when you joined, and you became a partner very young. So you've been locked in for quite a few decades now.
For a long time, yeah.
Okay, and over that time, what is it that has made staying at Baillie Gifford so compelling? I mean, sure, you became a partner early on, but being a partner of a small, boring, failing company wouldn't have stuck you out. So, what has it been about Baillie Gifford that's made it such an interesting place to be and be such a success?
Well, I mean, in short, it's because it has been developing and evolving ever since. So, it's been quite a journey. When I joined, there were probably fewer than 40 people. We probably had a dozen clients, less than £1 billion, about £600 million under management. And you wind forward to today, and it's 1,400 people and 300 billion. It's gone from a very parochial. I think I was quite unusual in not being Scottish when I joined. Whereas now we've got 48 different nationalities across the firm. Two-thirds of our clients are overseas. It's become a really, the whole act of building a firm like that has been very exciting, great fun, always interesting, and always challenging. And what the firm had, even from the day I joined it, was a collection of very, very bright people, who were very professional and wanted to do a very good job. So it's that combination of having people that cared and an opportunity set that just kept getting, bigger and bigger and bigger. So the business has transitioned a lot. So when I joined, probably 90% of the business was investment trusts, which at the time were slightly sort of dinosaur-like. No one was really sure what an investment trust was for. The big shareholders were insurance companies who were beginning to do their own investment. So they didn't really need to outsource it to investment trust managers. So they were strong sellers of their investment trust holdings. So investment trusts sold at a big discount. So you weren't able to launch new trusts. They weren't growing. If anything, they were shrinking. So Baillie Gifford looked into the pension fund market to try and diversify away from what I think everyone thought was a dying part of the business. And so we started looking for DB pension funds in the UK. That was very successful. Then we started in America. That took some time to get going, but in the 90s and 2000s was very successful. And then we just followed, the pension consultants helped us a lot. They took us overseas because a lot of the global pension consultants, you only had half a dozen firms to impress, and then you'd get on the shortlist and you would be offered to pitch. So that was great. So we rode around the world pitching to big pension funds and winning, our share of that and building up a big business. It's quite interesting that now, recently, of course, DB, defined benefit pension funds, are all closing. They're de-risking. They're moving away from equities, away from active managers, if they still have equities. So that part of our business is shrinking. We're getting outflows almost every year now from the pension fund business. So we've had to I won't say reinvent ourselves, but redirect our efforts into the growth parts of the market, which are really more the savings rather than pensions. So DC pensions maybe, but the self-directed savings, the wealth managers, people investing through platforms, through intermediaries. So more retail. And guess what? Investment trusts are at the heart of that. So we've done a full circle. So investment trusts are now probably the most healthy part of our business. We've been adding mandates. Almost all of the trusts we've got now trade at small premiums, so they're able to issue some equity. So instead of shrinking to non-existence or irrelevance, they're now growing again. And in Monk's case, in the 20 years, 15 years from 1999 to 2015, almost half of its share capital was bought back. The company shrank by almost half the number of shares. And since my team took it back, we've removed the discount, and now we've started growing again. Now, so far, we've won back about 5% of the 50% that we shrank, but it's on a much healthier footing. So it's back in a healthy state.
That's really interesting. So the market has basically become full circle since you joined. Well, what's driving, do you think, that return of the retail investor? I mean, obviously, at MoneyWeek, our readers are really interested in investment trusts, and everyone is very much a DIY investor and self-directed, etc. But that's still a reasonably small part of the market. So what's driving this return to investment trust by the retail investor?
Well, I guess I don't know. This isn't really my specialist subject, but I guess pension freedoms. I mean, if you now have to look after your own pension, your own savings, and you either find an advisor or give the money to a wealth manager to look after for you, or you DIY on an investment platform, and
Yeah.
that's got cheaper and easier. There's more information available, and of course, a lot of people probably want to pick stocks themselves, but it doesn't take too many expensive mistakes to realize that there is a role for the managers to help you pick stocks. So, the
Mm.
funds, investment trusts, or OICs can both be a very good way for individuals to get a spread of risk.
Yeah. But none of this would
Yeah.
work, Charles, for Baillie Gifford or for anywhere else without the performance. And so we've talked about the various things that have driven the business of Baillie Gifford over the last 30 years, but actually the thing that's really driven the business has been good investment performance. Because without that, none
Yeah.
of the other things that you're talking about would be possible. So let's move on to that and talk about what are the drivers behind the fact that Baillie Gifford has managed to maintain this very good performance for so long. What are the things that make it different?
Well, certainly over the last 15 years, that since I became senior partner, I think it's been going on for a lot longer than that, but we've had two principal aims or strategies. And one is to try do everything we can to get better, uh, and better at investing, better at keeping in touch with our clients. And the other is to remain relevant to our clients. And as our clients' requirements change, to make sure that we change as well. Um, and I think that's driven both the shift in where we look for client money, but also the way we invest. And it has meant that we've been able to become, probably since about 2000, increasingly ambitious about the returns that we seek to achieve on behalf of our clients. I think the 90s, the whole industry, and we along with it, particularly with the growth of the pension funds, we all got a bit stuck in this. Most of our clients didn't even have a performance target. As long as you did better than the average, that was the big challenge. Beat the median, or beat the peer group median. Um, and performance wasn't really the big driver. It wasn't a big differentiator. The pot was growing, so you didn't really need to stick your neck out too far. But from about 2000, we became notably more ambitious in our expectations, and we redesigned a number of investment strategies to have more aggressive performance targets. To outperform by 2 or 3% per annum, not every year, but over rolling 5-year periods. And more recently, that there are some of our strategies that publicly talk about 3% or in excess of 3%. And that was pretty unusual at the time. And it does mean, it's very challenging. It's very, very few managers do that. In fact, as we know, the majority of managers, after you've knocked their feet off, actually underperform the benchmarks. So promising 2 to 3% after fees is very challenging. And you have to really, really focus on the research that you're putting in, the way you manage the money, the way you structure the portfolios. And be very clear on what your competitive strengths are and stick to your competitive strengths. So don't get distracted by, particularly in our case, short-term market moves and things we don't understand or have no ability to add value to. And our strength is, I think, in analyzing businesses, in analyzing long-term trends, and in sticking the course, in assessing management teams and companies with a strong culture where you're happy to effectively invest your clients' money for 5 to 10 year periods because you trust them in the end to be the winners. So, we try not to be distracted by short-term performance, by politics, by macroeconomics, by shifts in exchange rates and interest rates. Because none of that do we have a differentiated view. We're just company analysts. So actually simplifying the task, I think, has improved performance quite a lot. And then there's quite a lot of internal stuff about, each of our investment teams has full discretion, full autonomy to run its own clients' funds as the team sees fit. So there's no house view, there's no house diktat. And that has changed. 30 years ago, we would have a policy committee that would say, right, everyone has to own oil companies and they've all got to own these two oil companies and they've got to be at least 5% of the portfolios. And we've abolished that. We don't have a chief investment officer. What we have is 20 chief investment officers, each masters of their own strategy. And in my case, it's been a strategy called Global Alpha, which we started about 15 years. So, we make all of our own decisions. I don't have to own a stock because one of my colleagues likes it. I get to talk to my colleagues, read their research, and if I want to buy it, then I can buy it, but I don't have to buy it.
But there's still very much a house style. And you wouldn't last long over a Baillie Gifford as a value manager. This is very much a growth orientated house. Talk about your global alpha strategy. Let's talk about that for a little bit. And very, very growth orientated.
Yeah, I mean, growth is the house style, but I think what's really strong, the strongest element of everything we do is the long-termism. And it's the long-termism, thinking 5 years plus ahead in your thinking and actually in the way you treat your staff and develop your staff and all of that. That is the differentiator, but that leads you to growth stocks rather than the other way around. I think that we know that our competitive advantage in this industry is the ability to take a long-term view and not be sacked if it doesn't work in the first year or 18 months or 2 years. And we trust our colleagues to, reach the right decision on a long-term perspective. And it leads to better results in the long term. So it leads to far fewer U-turns, damaging U-turns, people giving up at the bottom or, throwing the towel in, just as they're about to be proven right. So I think the long term is the key, and that's institutionally built into our independence and the partnership and everything else. But that leads you to growth stock, because if you're going to own a company for 5 or 10 years, how are you going to make money? It's not through the price you pay, it's through what the business does over the next 10 years. Does it grow its revenues, profits, cash flows, and whatever? So time frame leads you to growth. Value investing is much more buy it when it's 50% cheap, and when it goes up, hopefully, then you can sell it and find another one. But it's about discovery and rotation of your money rather than buy and hold for 10 years. I've always felt all the wealth.
Sorry, Charles, carry on.
Well, no, the wealth is created by the people running the businesses. It's the growth in the business that creates the wealth. And the shareholders, people like us, we're just along for the ride. I mean, we're passengers. You could say we're parasites, but we're passengers on these growth machines. And our job is just to identify them, invest in them, and then support and, try and help them if we can to make the right decisions when it comes particularly to capital allocation and so on. But they're the ones doing the work and creating the value. It's not a trading exercise. It's not a buy, sell, buy, sell, buy, sell. It's a think, buy, hold.
But you're not really a passenger. I mean, you say that you're a passenger, but isn't one of the driving forces of your strategy is the idea that you're in early, that you stay for a long time, and that you're there to engage, assist along the way. So it's this style of long-term investing in fast-growing companies is about a lot more than being a passenger. Well, that's certainly what we're told.
Yes. Okay. Well, maybe it's more like the rider of the horse than the passenger on the horse's back, if you like. But it's the company that does the work and gets you from A to B, and we hopefully can build up a rapport and an understanding with the management of the company. That means we can just sort of help them to stay on the right path and get there in the right, as helpfully as possible. And I think that is part of, stewardship, which is becoming an increasing responsibility on all investors, and quite rightly so, to actually be a sort of help to companies. So, that's what we call actual investing, which is being supportive investors to try and help companies realize their full potential, to try and help companies not make mistakes. But it's still, we're not telling them how to run their business. We're just trying to be supportive long term, encourage them to be long term, and to make the right decisions, the big turning points. And I think if you have been a shareholder for 5 or 10 years, and especially if you own a decent, few shares in the company, they will come and talk to you about what you think we should do and how can we do this better. So it helps them and it helps us.
Okay, well, let's move on, if we can, to talking about some of the stocks that you are interested in. Let's look at Monks, which you've been involved with for a long time. And Monks has also been one of the investment trusts that has been with Baillie Gifford for decades and decades, hasn't it, since the 20s? So let's look at that. And can we talk a little bit about the portfolio, how it's changed over the last few years, and what you think of the really interesting bits inside it?
Yeah, no, well, delighted to.
That was a big
So
question, but I'm
I've
just
been,
letting it.
yeah, well, I got involved with Monks about 6 years ago after the trust had had a more difficult 4 or 5 years of performance. And we took a slightly different line from the previous team that were looking after it. But since then, our approach really hasn't changed at all. So Monks is a reasonably diversified. We own a broad range of growth companies. We take long-term views. We try as much as we can to apply patience to that mix. And we were very clear that it's all about capital growth. So one of the first things we did when we came in 5 years ago, 6 years ago, was actually cut the dividend. Now, I don't think anyone ever owned Monks for the dividend yield. It was, we cut the dividend from a sort of 1.5% yield to virtually nothing. But that was underlining our view that it's all about capital growth. And the best use of our capital is to be reinvested so that more of your money can earn the superior returns that we think we can earn. So, the portfolio, if the approach hasn't changed over the last 5 or 6 years, the portfolio has changed a bit. Annual turnover has been probably a bit less than 20%. So only around a fifth of the shares typically will change in a year. And you may remember, in fact, in our previous interview, I think you were teasing me about our four growth buckets. So with Monks, we use it's quite a strict structure. We build the portfolio in relation to four different growth categories, and we go into this in the annual report, but we have stalwart growth, rapid growth, cyclical growth, and latent growth. And in simple terms, over the 5.5 years, we've made a major shift away from cyclicals. So cyclicals were about a third of the portfolio, and now about 14%. So we've significantly reduced the economic risk and exposure of the portfolio. And in turn, we've moved most of that money into what we call rapid growth stocks, most of which are secular, technology driven, a lot of internet and e-commerce and stuff. But that's gone from 30% to over 50%, just over 50%. So a move away from economic sensitivity, especially in America, as the recovery from the financial crisis worked its way through. And then the icing on the cake, of course, was when President Trump came in and he cut taxes and he boosted spending. And it was a sort of, there was a lot more talk about American infrastructure, I think, than actually happened. But that gave the final sort of surge to American domestic economic sensitives. And so we took advantage of that to take our money out and put a lot of it into a lot of these new technology companies, which are really building up a head of steam in terms of disrupting old markets, undermining old companies, and creating new. And that obviously worked quite well. So that meant when 2020 arrives, that we happened to be exposed to many of the biggest winners. And we had very little exposure to the sort of economic sensitive businesses globally that have been hit hardest by the pandemic. So, I think a lot of it was luck, but it was based on 10 years after into an economic recovery. Why would you still be owning cyclicals? Everything good that was going to happen has already happened to the cyclicals. and there was far more opportunity in some of these long-term growth areas. So it does mean, as a result of all that, and sorry, that's rather a long preamble, that Monk's current top holdings are dominated by a lot of the companies that have done best. I mean, that's why they've become the biggest holdings, because their share prices have appreciated. So our largest holdings, our two largest holdings actually have some similarities. So our largest holdings are Naspers. We also own its European subsidiary. So Naspers plus Prosus, its European subsidiary. And the other large holding for us is a combination of Alibaba and SoftBank. Now, Naspers and SoftBank are both really interesting. One's South African, one's Japanese. They were both very early investors in Chinese internet. So Naspers was the largest shareholder, or largest outside shareholder, certainly in Tencent. And SoftBank was one of the very early and largest shareholders in Alibaba. And both of them, weren't one-hit wonders. They didn't just make one successful investment. They've had, and sort of 20 years ago, they've had a very successful history of effectively venture capital, of backing, starting up businesses, growing businesses, sharing expertise around the world, and both with a focus on e-commerce, on social networks, on payments, and increasingly now on artificial intelligence. But they both still exhibit the sort of long-term thinking that we like in terms of their Tencent and Alibaba investments, which they still own. They trimmed, but in each case, they still own about 20% of the company that's made their wealth. And they both still trade at big discounts to their net asset value. So they're like investment trust holding companies with a technology focus, trading at big discounts. And we think they are, in both cases, great people to allocate capital to allocate on behalf of our shareholders. So we like those two, and particularly now Alibaba, as you know, as the share price has been a bit weak recently because of Jack Ma and the pulling of the anti-financial IPO. And I have to say, through SoftBank, you're now getting in at a big discount to a depressed share price, and that's usually a good time to be buying. So that's why we're happy for both of those to be our largest holdings. Then next on the sort of top 10 list would come two of the biggest drivers of our past performance, so Amazon and Tesla. No introduction needed to what either of those do. But interesting, in both cases, we have recently been reducing, still in our top 10, but we have been taking money out and recycling it into some younger and smaller companies, opportunities. I think we're both, we both like both companies still, despite what the share prices have done. But partly as a factor of size alone, they are beginning to offer more limited upside than some others. So we've been rotating money. And one of the companies that we've rotated money into is, for example, Farfetch, so the online luxury goods platform, which is now also in our top 10, and which has almost, in the space of 18 months since Monk's bought it, emerged as it's been the anointed winner in online luxury goods, particularly in China. So it's been endorsed not only by a large number of the luxury goods companies, the Louis Vuittons and so on, but also its two biggest competitors, who were Net-a-Porter and Alibaba, both of whom late last year decided almost to throw in the towel, but to join forces with Farfetch, and have become shareholders and working with them. So that one has had an amazing 6 months, which has pushed it right into our top 10. And then I won't go through the whole lot, but just to sort of give you the full picture, our top 10 also includes three steady long-term compounder businesses. So what we call growth stalwarts, the companies that can grind out growth at 10% plus rates, come what may. And in Moody's, Microsoft, and MasterCard, so three of those. And then just one cyclical company currently in our top 10, which is Ryanair. Again, no introduction needed. Europe, Europe's leading low-cost airline, where we've been adding quite recently. So that gives you a hint at our thinking. But Ryanair is a clear structural winner in a cyclical, deeply cyclical industry. And we expect it to gain significant market share and to be significantly bigger and more profitable in 5 years' time, specifically as a result of the weakness of its major competitors, which the lockdown has just compounded. Uh, I did notice yesterday that Air France has a market capitalization now of, I can't remember if it was 2 or 3 billion euros, but it also carries 23 billion euros of debt. So I don't think Air France is going to be expanding over the next 5 or 10 years. Uh, and that's going to be the case with so many of the big airlines, whereas the low cost Ryanair and Wizz, I think, will be gaining share hand over fist. So that's a sort of quick glimpse at the top 10. I don't know if you want to go anywhere with any of them.
Well, actually, I'll tell you what, and Ryanair is quite interesting actually, because one of the things that we've been talking about a lot at the magazine is the extent to which the companies in the sectors that are very fragile at the moment, there will be companies that have a wonderful time over the next few years because as capacity disappears and they can inflate their prices, etc. So Ryanair fits very nicely into that. That's interesting. But I think what we might be interested in is some of the companies down at the bottom. You've got 100 holdings odd in monks, which I always find quite interesting in itself, because one of the things that Baillie Gifford talk about a lot is how the majority of the returns in the market come from a tiny number of companies, right? But then you have this very large portfolio with 100 in it. So I'm quite interested in the stocks at the bottom. What are the ones you're holding small amounts of that you might expect to turn into those huge returners over the next 5-10 years?
Okay, well, there's sort of two questions there. So the one, why do we have 100 companies if we know that only a small proportion are going to be the winners? It's so that at the time we invest in them, we don't know which ones those are. So we've got to cast our net widely in order to hope that in our portfolio we have half a dozen of the sort of the next generation of Amazon and Tesla. And of course, Tesla we bought 8 years ago when it was capitalized at about $3 billion. No, I mean 90% of people thought electric cars wouldn't work. It was very high risk, but very high potential upside when we bought it. And we bought a small holding, and we tended to keep the holding small, even though the share price went up very quickly after we bought it. And so there are. That's why we have a lot of holdings. Is we're casting our net widely in the pursuit of the big winners. We're not casting it widely to have a bit of everything. So most of our smaller holdings at the bottom have this outsized upside potential, but they're not proven yet. We don't know that they're going to win. So if you wanted to, 3 or 4 examples from the bottom where, which I hope could be the next Tesla. There's one that we bought, it only IPO'd in July, but an insurance company, American insurance company called Lemonade, which is basically bringing artificial intelligence and social science, sort of behavioral science, to insurance, which is an enormous but very backward-looking, slow-moving industry. And this is a complete applying all the new whiz tech technologies to better pricing risk and better matching up with your customers' requirements. And simply because it's a small company in an enormous industry doing something completely different, we bought an incubator-sized holding. It's currently, and rather surprisingly, it's already appreciated fivefold since then. But it could, of course, become a $100 billion company, not a $10 billion company. And another one which people will be familiar with is Lyft, which is the sort of purer version of Uber. So it's the number 2 ride-sharing company in the US. And it only does ride-sharing, whereas Uber does Uber Eats and lots of other things. And Uber is global. Lyft is ride-sharing in America. And again, a little bit like Ryanair, we bought it while the US was in lockdown and revenues or rides were down by 85% or whatever. But this is another company that is run by its founder, as is Lemonade, still run by its founders. It has a very clear mission, a strong mission, which is to reduce the number of cars on the road, to improve the planet. Very strong culture, and very early stage, developing this concept of transport as a service, which I guess any of us who have used Uber in the UK will be familiar with. But it's really the gentler face of ride sharing. And in terms of the scale of the opportunity, it is immense. In terms of the company's focus and wanting to challenge, it's huge. And again, when we bought it, the valuation was particularly depressed. And I think one of the lessons is you don't get early into an Amazon or a Tesla if you're not prepared to put up with the skepticism. And they are unproven. It's just the size of the opportunity relative to, and do they have a company? Are they driven? Do they have the right cultures? Can you see it succeeding? So we invest in small holdings in those sort of companies, and then there's a few that we've owned for a bit longer. Chegg in online education, again, huge winner online education over the last 12 months. But we bought it 3 or 4 years ago as a small company trying to do something different to take learning online. Zillow, which is the sort of American right move, but more so. We've owned that for a few years now, but been very strong. Teladoc, in terms of telemedicine, this is again American, but America's leading by some distance now, largest telemedicine companies. So, medicine, healthcare is going digital. It's going online. And it's not just the diagnosis that's going to benefit from going digital, which is a separate subject, but the way we interact with medical experts, the way we get advice, the way we get reassurance about our illness, or the way they monitor whether we're taking our pills or our treatment, that's all going to shift online. And it's going to be safer and cheaper for everyone and better and more accurate. And the companies, it's really an industry that's only just got started. So we own Teladoc in America. We also own one of the Chinese ones listed in Hong Kong, Ping An Good Doctor. So there's lots of early stage. Some of them are beginning to get into their stride to show that they're likely to be the winners. So in some of those cases, we would buy an incubator holding, but then when they demonstrate that they're not going to disappear overnight, the risks are reducing, they're beginning to get traction, then we can add and make them a larger holding. And ultimately, hopefully, they can become an Amazon or a Tesla and become a significant holding.
A lot of the
Sorry.
stocks you're talking about are that's very interesting. I'll tell you what. Here's a little aside question. As you retire, I bet you're going to be holding on to various holdings in Baillie Gifford investment trusts, etc. And I know we don't have to worry about your finances, but are there any particular stocks that you just won't be able to let go of on an individual basis that you think, well, you'll hold personally and hang on to? You don't have to answer this, but it's fascinating if you do.
Yeah, I don't know. I'll have to think about how. I mean, at the moment, most of my money is invested in Baillie Gifford funds, and so I will carry on being shareholders in those funds. Most of my money is either in Monks or the Global Alpha Growth Fund. So, I've for the next
But no
5 years,
stock
I'll be
just
all right.
can't leave behind.
I No, well, it's really up to my successors as to whether they hold on to some of my favourites. But I would hope that the Ryanair and SoftBank will still be there in 5 years' time. Um, I hope lots of these earlier stage companies will have grown into proper companies. And as I said, our turnover typically we the portfolios only change incrementally. They change quite slowly over time. So I'm not expecting a clear out when Spencer and Dad take them.
Okay. A lot of the stocks that you've been talking about are, one way or another, actually beneficiaries of lockdown and COVID and all the things that have happened to us over the last year or so. Is there anything in the portfolio that is very specifically a beneficiary, companies that might be working on vaccines or on any kind of treatments for COVID?
Well, we've got the one obvious one, which I'm sad to say we haven't owned for very long, but Moderna. So the manufacturer of one of the three, well, one of the first two vaccines to be approved. And Moderna is a fascinating company that actually my colleagues have been close to. I mean, it's a young company, and the vaccine is only its second successful product, I think, second product on the market. The first was another vaccine. But it's got a whole new approach to drug discovery, drug development. And it's basically, again, using digital data tools um, and based on sequencing and RNA. Um, and they've basically got a platform now. I think with the COVID vaccine, they've demonstrated, one, that they can develop drugs, two, that they're safe, and three, that they can scale up the manufacture incredibly quickly. So they've done, I mean, it's been less than a year already, but they've done what would normally take a drug company about 6 years, and they've done it in 10 months. And it's and in fact, they claim that they worked out what they needed to do to provide a vaccine in just 2 days. And the rest of the time has been taken getting the regulatory approvals and building up the manufacturing and so on. So that is a clear winner. And we think that Moderna is not going to stop at a COVID vaccine. It's working on 6 other um, um, verticals, 6 other different illnesses already, and it's going to add more and more because it's a whole new way of making drugs. So that's the most obvious one. I mean, there's lots of beneficiaries of lockdown rather than vaccine and the way out. But I think probably the lasting ones will be the telemedicine, possibly grocery delivery. You know, we're all getting very used to. Actually, out here, I live in the middle of nowhere, and we don't get groceries delivered. But I think those who live in towns and cities have all probably become addicted to getting your groceries delivered. And why would you
I'm
ever
addicted.
go back and start with you? So I think there's some lasting beneficiaries, but Moderna is probably the most direct vaccine beneficiary we've got.
Thank you. So, can I ask one sort of rather more general rather than stock specific question, which is that Baillie Gifford, Monks, a lot of the trusts and funds at Baillie Gifford are very, very tech and growth orientated, and we talk and US orientated, and we've talked a lot about how wonderful all these companies are, which is a given in lots of ways. And we talked a little bit at the beginning about how it's not the price you pay, it's the way the business develops that matters. But actually, valuations are very high. It's impossible to argue against it. Are you concerned about the performance of, say, Monks with its massive holdings in your Teslas and your Amazons, etc., over the next, say, 3 or 4 years?
Well, with Monks, I can tell you that we don't have massive holdings in Amazon and Tesla. They're both between 2 and 3% of the portfolio. And one of the USPs of Monks in particular, it has this 100 holdings. It has 4 different growth categories. So yes, around half the portfolio is exposed to what you might call the new economy, technology driven, whether it's healthcare or e-commerce or social networks or music and video streaming, that stuff. That's probably about half of Monks. But it's not everything that Monks does. And the other thing about Monks, which I should have said earlier, is we like to run a flat portfolio. So it's not, 5 holdings of 10% each and then lots of tiddlers. It's everything is either side of 1% because 1% is roughly the average holding size. So we don't have extremes in terms of holding size. So because we have this ability to invest in cyclicals, and I mentioned Ryanair, which we've been adding, probably totally unexpected for you or many of your readers, we've recently been for Rio Tinto as well. We think it's going to be. We think it's going to be a strong growth stock over the next 5 years. We think profits, cash flows are going to be very strong, partly because there's going to be some stimulus on the demand side. There's going to be a lot more money spent on infrastructure, and particularly green, environmentally driven investment. which needs copper, which needs steel, which needs lots of things that Rio tend to dig up. But the other side of it is, I think you touched on it, for the last 5 years, 6 years, there's been an investment strike by the global miners. They got terribly overstretched in around about 2010. So from 2014, they've basically all stopped expansionary spending. And so suddenly they're now finding, or everyone is finding, that a large number of industrial minerals and metals are in short supply. And that's happened during a pandemic when half the world shut down. And we think it's going to take 5 years plus for the supply response to come through, because it takes between 7 and 10 years to open a new mine. So there's going to be a shortage of lots of stuff, and prices are going to go up, and the Rio Tintos are going to make out like bandits. So we have space in our portfolio for, if you like, a little bit of a counter to some of the valuation worries and the narrowness of the market.
Oh,
So
that is
I'm not going to argue that some of our shares have done rather better than we had expected. In some cases, that's because their businesses have done rather better than we had hoped. But in others, some of it, the valuations have gone up. And we've started just a gentle spread away from some of those technology companies.
Okay, brilliant. Thank you. Charles, while we've got a few questions coming in, and we have a few minutes left. So I'm just, if you don't mind, going to ask you a couple of questions from the readers that have come in this morning. Now, okay, let's see here. Given the importance of the subject, would Baillie Gifford consider launching a specific climate change fund, as some of the other big fund managers have done? Is that something that is a conversation over at Baillie Gifford at all?
I think it is a conversation, and we are currently, we've got some of our colleagues are developing a strategy for what they're calling a climate optimism fund. But I think it will be some time before that's made available to the public, because we need to prove to ourselves. What we typically do is incubate funds internally before we launch them on the public. But what people may be aware of is that there's a new investment trust shortly joining the Baillie Gifford stable, the Keystone Investment Trust. And that's going to be, when it comes to us, it'll be invested in what we call our positive change strategy, which isn't a climate change strategy, but it is a global challenges strategy, of which one is climate change. So it's not purely on climate. It's also on wealth inequality and education and water scarcity and food and other big challenges. But that will be available from early February under Baillie Gifford's management. But no, we typically don't rush to pump out a fund to get the latest, whatever the latest theme is. We're not launching a mining fund anytime soon just because we're interested in mining. It's all pretty considered. We do incubate things, make sure they've got proven management teams, that we can do it. We won't do anything unless we're sure that we can do it well. And that, we need to demonstrate that to ourselves first.
Okay, we've now got quite a few questions have come in actually about political risks, and I know that's not something that Baillie Gifford you like to think about as part of the equation, but there are some significant political risks out there, and the questions are coming in are focusing on two things. One is the Ma saga in China, which we've briefly touched on, and the other is the new US administration and the potential regulatory risks to tech companies there. So we're getting quite close to running out of time, but if I could just ask you to comment on those from a stock-specific point of view.
Well, I would tie those both together. The regulators will step in when, and probably only when, the governments feel that the companies aren't fulfilling their responsibilities, that companies are abusing their position or not doing what not working to the benefit of the whole of society. And that has always been understood. We only want to invest in companies that are working with society to improve it, rather than sort of trying to pervert society. So And in China, that has always been very explicit, that these companies have been very successful because they are advancing the social project, which is to take 1 billion Chinese out of poverty, which they've done and been doing very successfully. So regulation is sort of needed when the companies themselves fail, and we see our job as trying to encourage the companies not to fail, so the regulation can go away. So we're not massively, I don't want to invest in a company that's abusing its position. So I think it's healthy that if in China they're worried that the companies have gone a bit too far, it's a warning shot. Don't go so far. Don't forget your wider responsibilities, and that will lead to a longer duration growth. If they're doing the right things. So generally, not massive. I mean, not blasé about it, but as long as the companies behave themselves, any regulation shouldn't be too damaging to them.
In the US as well.
In the US as well. Now, the US, the issues are very complicated. You come down to sort of freedom of speech and those sort of issues. But and I think the companies do have, they haven't quite got it right, have they? They've either allowed everyone to say whatever they like, and then they start censoring, and they're sort of unpopular with both left and right. But that really only affects one or two. That affects Facebook particularly, and maybe Google. But of course, Amazon isn't, peddling news or making political statements. And so, most of the others aren't big enough to be seen as a big threat. We don't own Twitter, I guess, which is another one that could be in the firing line. So I think it's manageable. It's not all the big tech companies, and it's not irredeemable, if I can put it that way. It's not too late for Facebook to do the right thing.
Okay, Charles, thank you so much. I think we'll have to leave it there, but that was absolutely fascinating. I really enjoyed talking to you, and I think we all wish you a happy retirement.
Well, thank you very much.